So you want to get started with investing because you've heard that's the right thing to do when you have some money saved up. But you also don't really feel comfortable putting your hard-earned money in because there are still too many aspects and terms that you don't understand well enough. You want to invest, but you don't know where to start and what you should buy. Is it stocks, bonds, real estate, gold, crypto, NFTs, oil, or even art? There are so many options and even more opinions on the right way to do it. But in the end, your biggest concern is not losing the money you've worked so hard for. I've been in that same position and I've spent the last 8 years learning about personal finance, money, and investing. And I've even worked at an investment fund. This has taught me a lot about what you should and especially what you shouldn't do when you first start investing. So the point of this video is to give you everything you need to get comfortable investing your money. First, we'll start with some steps that you need to follow before you can invest. And second, we'll discuss some of the basics and terminology that you need to understand and why it's so important to invest. We'll also talk about some great ways to start investing your money today. And finally, we'll also address some of the main concerns, fears, and questions that people often have. So with that being said, let's dive into the video. Before you can start investing, you need to take a good look at your personal finances and take control of them. The first thing you do is to create a budget. You probably know how much money is coming in every month, but most people don't have a clear view on what they're spending it on. Start tracking your income and expenses. Then prioritize your spending and create a budget plan where you have some money left over each month to save and invest. Be realistic with your budget and adjust it as needed. Use tools like apps or spreadsheets to help you stay organized and on track. Now we have a better idea of our finances and we can start building an emergency fund. I have talked about this in another video where I explain that it's just a great way to give yourself some financial room in case something happens, like losing your job. It means that you need to save up at least one, but ideally between 4 to 8 months worth of expenses. You could first build up a 2-month buffer before you start investing and then slowly grow it into as much as you need to feel comfortable while also investing a little bit at the same time. The next step is to make sure you're paying off especially high interest debt as soon as you can. The average credit card interest rate is around 22%, which will probably outweigh any returns your investments will make. So if you're not able to pay off your credit card as soon as possible, you're just throwing money away. The last step is to open a retirement account if you don't already have something like that in place through your current job. It's not a necessity because you can also just invest through a normal investment account with any broker that is available in your country, but they often come with tax advantages and other benefits like the company you work for matching a certain percentage of the money you invest in that account. There are many different types of retirement accounts which also depend on the country you live in. For example, in the US, the popular ones are 401ks and Roth IRAs, which are often set up through your workplace. But most countries have similar structures under different names, which you can just easily Google by stating something like, what is a retirement account, in enter your country name that is comparable to a 401k. This is a great way to start investing because with this you're automatically being invested in a mixture of stocks and bonds through mutual funds, which we'll explain later. But if you don't have this option or want more control, like I said, opening a standard account with any broker that is available to you is also fine. Now we got those steps out of the way, let's start talking about the point of investing. Why do we do it? The main reason to invest is for your money to be able to make more money. As we just discussed, we want to have some money saved up for emergencies, but the problem with just putting your money in a savings account is something that you might heard a lot about recently, which is inflation. This basically means that your money is losing its purchasing power over time. Something that costs $100 right now will cost you $120 in a few years, even though the product has stayed exactly the same. Why this happens is something for a different video, but right now we just need to accept that it does to understand why we want to invest in something that grows our money, so we can combat the effects of inflation. So let's focus on why and how our money will grow by investing it. The general philosophy behind investing is that you buy something now and that something makes you more money over time, either through growing in value or by paying you a certain amount each month or X amount of time. A simple example of this is when you buy a house, you expect it to go up in value over time, but you could also rent out the place so you get rental income each month. This doesn't work for all types of investments, and often you're depending on buying something for a certain price and then hoping you can sell it for a higher price in the future. I already mentioned a few of those investment types, which are called asset classes, and the main asset classes are stocks, index funds, and ETFs, which are fairly similar, bonds, real estate, crypto, commodities, and even more niche things like art. Because there are so many different asset classes, it can get very complicated very quickly. So to keep it simple, in this video we'll focus on the main kind of investing that most people can understand and do fairly easily, which is investing in stocks and especially ETFs. And even though I'm also very interested and invested in crypto, I'll leave that for a separate video because that also requires a lot of explaining before you can comfortably invest in it. Stocks and ETFs are kind of the basics of investing. And usually when people talk about investing their money, they mean buying something on the stock market, like Microsoft, Amazon, or Apple shares. So it makes sense to start there. We'll break down a few of those terms that I've just used, like stocks, the stock market, ETFs, and brokers, and I'll try to keep it as simple as possible. So a stock is something that represents a share or small part of owning a company. You're basically buying a percentage ownership in the company that you're investing in. So when you buy a Microsoft stock, you're owning a little piece of it, and when the company grows in value, the value of your stock is growing as well. The stock market is the marketplace where all types of stocks get traded and where stocks are held, so it shows all the different shares of company ownership and how they're performing overall. So when people say the markets are up or down, they mean that the average stock in the stock market have gained or lost value. In reality, we can't actually go to the stock market ourselves to buy or sell. We have to go through a middleman, which we call a broker. This can be an app like Robinhood, or an investment manager, or even through your own bank. And instead of just buying individual stocks of different companies, there is also something called index funds or exchange traded funds, ETFs. This basically means that you're buying only one thing, but it's a basket of, let's say, 100 different companies. So you're buying into 100 different companies at once without having to make all the effort of buying them individually. There are lots of different ETFs to invest in, and they all have their own structures in terms of percentages and what types of assets they hold. So like I said, it could be that the 100 companies all have 1% share of that ETF, but it could also be that some of the companies have a higher percentage share than the others. It's a really easy way to get diversification, meaning a wide spread of different assets, in this case companies, but there are ETFs for almost every asset class out there. The last thing that you need to know is something that we've already discussed briefly before, which is how to make money from your stocks and ETFs. You can do this in two different ways, and the obvious way, which we already discussed, is buying it at a certain price and then selling it in the future for a higher price. And the second way you can make money is by earning dividends. This is similar to our example of the rental income when you own a house, only in this case, the company which stock you've bought pays out money to the owners of its shares on often a quarterly or sometimes monthly basis. So some stocks, and not all of them do, pay out part of the profits that the company makes to the shareholders or owners of the stock. The amount you receive really depends on the stock you own and can change throughout the year depending on how well the company does and the decisions it makes. So let's tie this all together and show you how you can invest today. You understand that you need to invest to fight inflation, but you also want to invest because that means your money is making more money, which will allow you to grow your net worth without having to work for it yourself. This gets enhanced by something that's called compound interest, which basically means that when you reinvest the money that your money is making, you start this exponential growth cycle. So let's say you first invested $1,000 and that grows by 10% in 1 year to $1,100, which is a $100 profit. You invest that money and next year the $1,100 again grows by 10% to $1,210, giving you a $110 profit. This might not sound like that much, but when you speed up that process and look a few years in the future, we can see that it makes a huge difference on your investment. Okay, so now that we want to invest, how do we know which stocks to buy? How do we know which companies are performing well? And if that even means that the price of their stock is also going up? This is where all the different opinions come in on what to buy. Of course, you can choose some individual companies that you like, but that doesn't mean that they will perform well. They might, but that's more like gambling than informed investing. So to tackle this problem, there's an easy solution and one that I highly recommend to anyone who wants to invest, which is just investing in a broad market index or ETF. Unless you're a financial professional whose full-time job is to monitor the markets and research all the different companies out there, you shouldn't be trying to pick stocks, meaning picking the winners that will outperform the market as a whole. This is a losing game. But you don't have to believe my word for it. Warren Buffett shares the same opinion, and he is considered as one of the greatest investment minds that ever lived.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amounted to, and it would come to $51 million now.
So instead of worrying about stock picking, the average investor is better off investing in a broad market index or ETF. And as I explained, an index fund or ETF is a basket or a group of stocks and shares that tracks a particular stock market index. For example, in the US, the most well-known index fund is called the S&P 500, which are basically the top 500 biggest companies in the US. And the percentage that each company in the S&P 500 gets is based on its market value. So the bigger the dollar value of the company, the higher the percentage it will have in the S&P 500. There are lots of different ETFs out there, and some that are highly focused on certain sectors like technology or healthcare, but also some that just track all the companies on a certain stock market, which could mean that you own over 4,000 different companies through buying only one ETF. The point of the index is that it gives you a single asset that you can track over time. In the case of the S&P 500, it shows you how valuable the US stock market is, because most of the value of the US stock market is in those 500 companies. So if the value of these companies are slowly increasing over time, which it generally does, because the US economy is also growing over time, that means if you own that ETF, your money is growing alongside it. So if you want to start investing today and keep it simple, you should just pick a broad market index like the S&P 500 and start there. This is also what Warren Buffett recommends.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. The trick is not to pick the right company. It's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500. and to do it consistently, and to do it in a very, very low-cost way, because costs really matter in investments. If returns are going to be 7 or 8% and you are paying 1% for fees, that makes an enormous difference in how much money you have on retirement.
So you're better off diversifying your money across the market as a whole. And you're not trying to beat the market, you're trying to track the market. Now, all you have to do is find a broker in your country and search for an ETF that you like. Maybe one that tracks the S&P 500 with the lowest fees possible, and start investing. Make a habit out of investing every month, and with certain brokers you can even automate the whole process so you never have to worry about it. Of course, and this goes for everything that was said in this video, this is not financial advice. Do your own research before you make any financial decisions. Before we wrap this up, I wanted to address a few of the main concerns, fears and questions people often have when they think about investing. The main fear people have is, what if the value of my investments goes down or even go to zero? What if I lose all my money? And of course, it is true that companies can collapse and go bankrupt, but that would only really hurt you if you put all your investments into that one company. And this is not something that any average investor should ever do. That's why we looked at index funds and ETFs. This makes sure that we have a diversified portfolio of companies that we own. So if one were to fail, it wouldn't be that big of a problem. Of course, if you would have started investing right before the financial crisis of 2008, your investment would have gone down 30 to 60%. Now, if at that point you would have sold, you would have actually lost money. But if you just held on, then you would see that the market recovered over time, and you would have been up by a lot by now. Because overall, the stock market broadly goes up over a long enough time horizon. The reason why we can make this assumption is because it's been doing that for over 100 years now. And it's a reasonable bet to make that it keeps doing so in the future. Because as long as the country doesn't collapse, people will continue to build and innovate, and value will be created by them. So we can expect the value of those companies and the economy to rise over time, because people will want to continue buying whatever nice or useful stuff or service they offer. Another question people sometimes have is, how much money do I need to get started with investing? And the simple answer is very little. These days, some platforms allow you to invest with as little as $5, and at most it might be $100. But this depends on which app or broker you're using, which also varies depending on the country you live in. So do your own research and figure out what the best and most reputable options are for you. Like I said, there are a lot of different asset classes that you can invest in, and the point of this video is not to keep you from doing that. I've also made videos on ways to combine a stock and bonds portfolio, and I'll also be making a video on how to start investing in crypto, because that's something I'm investing in, but this might not be for everyone. And in general, you can't go wrong with starting your investment journey by investing in a broad market ETF, as long as you give it enough time. So that was a beginner's guide to investing and how to start investing today. Thanks for watching. I hope this helped you out. And if you enjoyed this video, please like and subscribe. It really helps me out and lets me know to make more of these types of videos in the future. See you next time.